Good morning, and welcome to today's webinar. We're excited to be discussing the newly launched Keeley Dividend ETF. I'm Charlie LaRosa. I help lead our ETF initiatives here at Gabelli, and will be your moderator for today. I'm thrilled to be joined by Tom Brown and Brian Leonard, portfolio managers of the Keeley Dividend ETF, ticker KDVD. Gabelli is a global asset management firm founded by Mario Gabelli in 1977. Today, we manage nearly $35 billion in client assets across value, growth, fixed income, and convertible securities through open and closed-end mutual funds, ETFs, UCITS, and separate accounts. Our dedicated team of analysts and portfolio managers conduct fundamental bottom-up research to identify high-conviction investment opportunities. Today's discussion will be focusing on the Keeley Dividend ETF, ticker KDVD, a newer addition to our growing ETF family at Gabelli. As an added benefit, the advisory fee will be waived for the first year from the fund's launch of December 8, 2025, before transitioning to a 90 basis point fee. We currently offer 8 actively managed ETFs, leveraging the ETF structure's tax efficiency while delivering differentiated, research-driven strategies. We're pleased to be joined by Tom Brown and Brian Leonard, the portfolio managers behind KDVD, and a highly experienced team that has been managing dividend-focused equity strategies together for more than 16 years. Tom and Brian joined Gabelli in 2025 following the acquisition of Keeley Teton, where they partnered for over a decade, managing the small cap and mid cap dividend value strategies since their inception in 2009 and 2010, as well as the SMID value strategy. Their long-standing collaboration combines deep fundamental research, disciplined dividend investing, and experience across multiple market cycles, bringing a proven, repeatable approach to KDVD. Tom and Brian, thank you so much for joining us today.
Morning, Charlie. Morning, Charlie. Happy to be here. Very excited to talk about dividends.
Great to see you both. Let's open it up with macro. Tom, maybe we'll start with you. As we look into 2026, what are the key macro or market dynamics you're most focused on? And why do those factors matter specifically for dividend or equity income investors?
Wow, Charlie, lots going on. I've got this list in front of me. We got Venezuela, we got Greenland, we got Trump's comments on defense, housing, and credit cards. And over the weekend, an investigation into Jerome Powell. Before the end of the month, we got the Supreme Court probably weighing in on tariffs and maybe a government shutdown at the end of the month. So a lot going on. Some of that's noise, some of that's going to turn out to be real, but the market seems to be shrugging it off. Looking ahead, last year was about rates and inflation. Inflation's lower, but still on the radar screen. And we think that we're most of the way, or at least more than half of the way through the rate easing cycle. So we think the discussion this year will eventually turn to the economy. And from where we sit, the economy looks okay. Not for everyone, and that could be an issue. But if you look at the setup, we've got stimulus from the One Big Beautiful Bill. We've got lower fuel prices. We've got lower interest rates. On the business side, spending on AI is going to be strong again this year. And then there's more spending on reshoring. Add to that the benefits of bonus depreciation, and the economy looks like it's okay. I think we're going to continue to muddle through. We haven't had a really strong economy for several years. And we think that, this is another kind of muddled through economy. And that'll be supportive for corporate earnings. From a market standpoint, multiples are kind of high for large caps, but reasonable for small and mid.
Yeah, I would like to just kind of, if you think about it, I'm reminding of a saying, may you live in interesting times. And boy, have they been interesting. I mean, Tom highlighted the geopolitical atmosphere as well as the domestic strength that we're going to see and the benefits of small and mid caps. But when you take it all together, it probably means volatility is going to be on the rise, and that will definitely, I guess, highlight the importance of dividends and equity income, making this webinar, I think, very timely, along with the launch of the ETF.
It certainly makes the launch of this ETF very timely. And I think as Tom started with, clearly nothing's going on, but quite a few events on the horizon, a lot of things that could be very much driving volatility throughout the year.
Yeah, it's
Maybe
only
just
January 13th.
Jiro, and maybe focusing specifically on rates and inflation, as Tom concluded with those thoughts. Maybe just the uncertainty behind rates and inflation. How are you guys thinking about those two dynamics compared to maybe 5 or 10 years ago within the portfolios that you manage?
Sure. Couple thoughts there, Charlie, is, first, given that we've had this bout of inflation, which was much higher than it is today, and much higher than what people had experienced over quite a long time, we think that maybe investors should focus a little bit more on earning streams that can grow, right? And dividends do that. Dividends over time grow in line with earnings. Bond interest payments don't, right? And so maybe, there's a little more focus on dividends as a way to generate income that can grow with inflation. The weighted average growth rate on KDVD's portfolio is about 4.5% last year. I think it's a little bit higher than that this year, and that's a little bit ahead of inflation. Second thing, the big change I think in the dividend landscape over the last 10 years is that small and mid cap stocks actually now yield more than large cap stocks. And people ask us, okay, why do you focus on small and mid cap stocks? And there's really two reasons. I mean, number one is there's a lot more opportunities. If you look at the chart on I think it's the right or the left, the one that looks like a circle, you can see that if you divide the universe into large, mid, and small, right, the Russell top 200, um, there's about 200 companies, and 180 of them, 160 of them pay dividends. So 80% of large cap companies pay dividends. But if you expand your universe into mid cap, you pick up another 500 companies. And if you expand into small cap, you pick up another 800 companies. So a much larger universe. And then if you look at the graph, um, you can see that over time, the yields on large cap stocks have come down while the yields on mid and small cap stocks have risen. And today, the Russell Top 200 has an average yield of 1.1%. Compare that to the mid cap at 1.6 and the 2000 at 1.3. You can see you get more yield out of smaller companies. If we just focused on, and we do focus on the dividend payers, the difference is even greater, as you can see in the chart.
Tom, very well said. And it's a couple points here. I mean, I guess number one, dividends in itself is just a good vehicle for investors to say, hey, I made an investment into a company and I'm being rewarded for that investment through some type of income payment. And it's very attractive to be in a company that pays a dividend because you feel like you're being rewarded throughout that investment while it's still growing. And I think it's interesting how you talk about there's this opportunity in the small and mid cap space with some attractive dividend payers that you normally don't think of. I think a lot of the typical strategies are more on the large cap side where there's more attractive dividend returns. So I think that sets the stage very well for, moving the conversation from the macro talk to more on dividends and dividends in itself. And I think dividends can be very exciting and it's obviously a key part of this investment strategy. But, maybe playing devil's advocate here, Brian, just turning to you, dividend investing often gets painted as more defensive or backward looking. What do you think investors get wrong about dividend strategies today?
Thanks, Charlie. Thanks for the question. I'm going to break it apart in two. I'm going to focus on two areas. First, the backward looking, and then I'll touch on defensive. Because if you really think about dividends, while a dividend yield is based on a dividend that already been announced, right, declared and paid, the event of a dividend is definitely a signal, right? So dividends are the clearest signal that is given by management on the prospects of a firm's financials, either through earnings and cash flows or that improvement of earnings and cash flows. And that signal or that announcement is even more pronounced as we go down cap. And the reason why it's probably more important in small and mid cap is the way that the information flows, right? Mega cap stocks, information's all over the place. You hear it on TV and the like. As you start going down cap, you hear less and less, right? These companies most likely do not do analyst days, and they may or may not hold conference calls. So management teams know ideally know more about the companies than people investing in it. So therefore, that dividend is very forward-looking. And if you just kind of look at the actions of a dividend, so say a dividend initiator, so a company that initiates the dividend, usually corresponds with a positive share price reaction, meaning it wasn't priced into the shares, it's a surprise to the market. Very similar to growers, right? If it's an above average growth that was unexpected, most likely you'll see a positive share price reaction. And then on the negative side, you have dividend cuts or suspensions, and that's very punitive and very painful for shareholders. I know many of us on this webinar have experienced that in their investing careers, maybe once, hopefully not twice, right? But in the event, it is very painful. And I think that really lends to the importance of a dividend, right? Because if a management team is committing to a dividend and a growing dividend, that really shows their commitment to the company and their credibility is on the line. And that's pretty much all a management team really has is their credibility. So I do believe that, yes, a dividend yield is backward looking, but the dividend action is very forward looking. Now, touching on defensive, we have a saying here at Keeley, the downside is the upside. Yes, these are mainly defensive stocks. As you go down cap, they're also tend to be higher quality. So think of 2025 non-earners and non-dividend paying stocks in the small cap space performed fantastically, while quality dividends and low volatility did not. So you have that defensive nature for when times are choppy, either through volatility or rough markets. So they tend to be defensive, and that is I think a positive attribute. But we'll touch on other kind of dividend categories that we focus on. But if you're growing a dividend or initiating a dividend, you have usually something positive happening fundamentally to the company. And that all investors can get behind, right? Improving margins, higher sales, better prospects. I think anybody who is not looking for a dividend would like those characteristics and attributes as well.
Brian, what stood out to me was that you mentioned the word quality, and I think that's really important to focus on because while your team has had the success managing dividend strategies for so many years, the reason that that strategy has been successful across all your different funds in the past has been that focus on quality. 16 plus years with that stock selection process of focusing on quality has allowed you to be successful in how you kind of evaluate companies. And I think we always talk about here at Gabelli of, the small to mid cap space. It's the ignored or unloved. And obviously we see it as an opportunity, as you pointed out. So I think that philosophy sets the stage well for diving right into the ETF VD. Tom, maybe just turning back to you. Why launch KDVD? Can you walk us through, what this ETF is designed to do?
Sure. We think now is a good time to launch. The focus on small and mid cap stocks and on dividend paying stocks is different. So we're differentiated from that standpoint. But from a timing standpoint, if you look at small and mid cap valuations, they're attractive relative to the S&P 500. S&P 500 trades at around 23 times forward earnings. That's about 2 standard deviations above the 20-year average. Small and mid caps trade around 15 to 16 times, which is in line with the long-term average. Secondly, the fundamentals look pretty good for small cap stocks, right? The domestic stimulus, an easier regulatory environment, M&A, all are typically associated with helping smaller companies. And then finally, dividend payers lagged. Brian talked about what last year was. Non-earners, lower quality, higher multiple, higher beta, higher volatility, all worked really well last year. Dividends did not. And so, the attractive fundamentals combined with recent underperformance, we think sets up for a good outlook.
I think it does set for a good outlook, Tom. And I think benefiting from those tailwinds of attractive valuations for the small to mid cap companies that this strategy focuses in on, as well as just benefiting from that lagged performance, as you talked about for dividend payers, is clearly a competitive advantage here for this strategy versus other dividend offerings. Maybe focusing on dividends itself, how does KDVD differ from a traditional dividend ETF? I mean, there's other dividend ETFs out there. Certainly, a lot of them are in clients' portfolios. How can you strategically use this if you're an advisor or, a investor that already owns a dividend ETF?
Yeah, there's about 100 different
Wow.
dividend ETFs, or ETFs with dividends in their names. And we think what differentiates KDVD from most other dividend ETFs is flexibility and then emphasis. In terms of flexibility, we can invest across the market cap spectrum, from small to mid to large. So we can look at opportunities anywhere. The emphasis today, and probably mostly in the future, will be on smaller and mid cap companies. But if small cap goes on a great run, and all of a sudden they look expensive to large caps, we'll invest more in large caps. The second point of emphasis of flexibility is where in the market cap spectrum we can invest. I'm sorry, in the dividend spectrum we can invest. So we'll buy stocks along the entire spectrum, from companies that pay very small dividends and don't grow them to companies that pay very large dividends and do grow them. So whereas a lot of dividend ETFs really focus on either growth or longevity of growing the dividend, or high yield, or other, have particular constraints, we're more flexible.
Absolutely. And, for our listeners out there, I think this is a really important point here is the flexibility. I don't think most investors realize the different types of dividend payers that can be part of a dividend strategy. So I think flexibility is key and is obviously a differentiator for this strategy. Brian, maybe you can introduce it to us and kind of really dive into what your team calls the dividend spectrum. Can you walk us through that framework and maybe just speak to us a little bit about the different buckets of dividend payer stocks? I always find this part fascinating for how your team looks at, portfolio allocation within the dividend payers.
Yes, definitely. And thanks for bringing that up and highlighting that. And that's probably one of the more exciting things about our strategy, right? If you think about dividends, people say, oh, why dividends, right? Dividends are just dividends, right? Management's throwing in the towel in growth and so on and so on. But I mean, dividends have been paid for centuries, right? It's a bedrock of a total return. But not all dividend paying stocks are created equally, and not all environments are favorable to each of kind of the dividend paying categories. So we focus on four main categories of dividend paying stocks. Attractive, right? It just happens to pay a dividend. We like the fundamental aspect or something else other than the dividend income component of this investment to really drive the return in shares. Then you have your solid steadies, right? And Tom mentioned in one of his remarks on the dividend growth of kind of the universe, eventually it will be in line with earnings. Now, earnings could be growing at a high single digit pace, and your dividend growth will match that at high single digit pace. But that is what we call a solid steady, offer average yields that grow their dividends in line with earnings. Growers are ones that are truly growing their dividend. We're looking for a double-digit growth or a major change from growth that they had in the past. Maybe they were solid steady, growing 3 to 5%, which is pretty typical of dividend growth in the marketplace. And now they're growing at a double-digit rate for whatever positive fundamental reason that is happening within their own company. That really stands out. And then lastly, high yield, right? The yield that is being offered on this stock is much greater than the market at large, either through the market is skeptical that the dividend can be maintained in its current form, or recently or as of late, it's more asset plays. Think of your REITs, sometimes your utilities, or some special situations, they'll fall in that high yield category. There's a subcategory that we look at as well that's not big enough yet to get a spot on the page, but that's dividend initiators. Right? That's something that I mentioned when we looked at forward-looking versus backward-looking. That dividend initiation is a fantastic area to invest in, because that's truly the true signal that things are much, much better than the recent past. There were 17 dividend initiators in 2025. The market cap range was 40 billion on the top end, all the way down to 50 million on the micro end. So it's a very diverse group. And that is also something that we look at. We track this on a weekly basis, both growth and initiators. It's very important to our process. But if you take the four buckets together, the four areas of focus together, and you think of a normal distribution, a bell curve, your tails, the two smallest part of the distribution, will be your attractive and high yield. Call it 5 to 10% of the portfolio. And then the solid, steady, and growers will be the bulk of that portfolio. It's a fine line between a solid, steady, and a grower. Most growers will morph into a solid, steady over time, but still yields those positive attributes. And then one final comment as well that kind of falls into the attractive bucket is corporate spinoffs. Charlie, you mentioned that Tom and I manage the the Keeley Gabelli SMID value strategy, and a hallmark of that strategy is spinoffs. About a third of spinoffs pay a dividend. So we have multiple avenues to invest in dividend-paying stocks that is vastly different, or definitely different than our competitive set in the ETF, dividend ETF universe. And why is that important? We highlighted on them, but the chart here on that we're displaying, dividend growth versus high yield, you can see various times dividend growth will significantly outperform, but there's also times when high yield will significantly outperform. So having a flexible mandate to invest in dividends across the spectrum really allows us the flexibility to take advantage of what the market is offering with respect to dividend paying equities.
Yeah, Brian, you brought back up the word flexibility, and I think that just summarizes what you said so nicely. And that was such an elaborate discussion for how the portfolio strategically uses that flexibility throughout. I think another important thing to highlight too is not only do you guys have the flexibility to operate in these different buckets, but picking companies from these different areas expand your investable universe. So I think as we point to that chart of the dividend growth versus the high yield, as market dynamics change or things impact how they're going to work its way into the portfolio from a macro standpoint, you both have the flexibility to adjust the portfolio accordingly. And maybe just a quick follow-up question. Is there a part of the spectrum, just knowing everything we know today and what we've talked about, that you would find more compelling based on the current market?
That's an interesting question. And the way I'll answer it is really not by answering it, right? Is by saying it's the flexible mandate or the flexible approach is the most compelling,
Sure.
right? Because oftentimes, right, in this business, the best visibility is hindsight, right? Hindsight's 2020. So if we know what's going to be a dividend growth stock and continue at an above average rate, we would invest in it significantly, right? Here you're doing your best work to try and find those situations. I think that flexibility, I think the one that would stand out kind of on an island by itself is the high yield, because there it is backward looking is the yield that it is today. But having that approach, I think is very beneficial. Being able to move in between, because an attractive stock could be your next dividend grower, right? Because you need that initiation first, right? And then we can see how fundamentals progress. Currently, there's three stocks within the portfolio that do not pay a dividend. Two of them are spinoffs, so they're expected to pay a dividend within the first half of 2026. And the other one is a special situation going through an asset sale, a strategic asset sale. And I wouldn't say really a reorganization of its business, but it is changing the way that it views the future. And also, this company paid a dividend prior many years ago, so they're reinitiating that dividend or making that commitment. So having that approach, I think, is I think the compelling attribute. But if I had to choose one, which one's my favorite? Initiator's number one, right? Because of the positive price performance, and it's truly a significant change. And then you see from this chart, dividend growth tends to outperform, and rightfully so, because of the positive fundamental attributes that the company is displaying at the time or is expected to deliver. So if I had to choose two, that would probably be the two that I would choose.
Yeah, and I'll add on to that
Sure,
is
please.
that we don't target, the portfolio to be X percent in attractive and X percent It's just kind of worked out that way, and it's been reasonably consistent over the years. Um, but really, what we're looking for is great stocks. And we use dividends as a starting point because if a company pays a dividend, it's telling you three things about the company, right? Number one, if they believe that they can generate free cash flow on a sustainable basis. What's not to like about that? Secondly, because they're making a long-term financial commitment, as Brian talked about, they're gonna be, or they have to be a little bit more um, careful about the other capital allocations decisions that they make. Is this the right time to buy back a huge amount of stock? Is this the great time to be making a large acquisition, right? So they tend to be a little bit more conservatively financed, all else equal. Um, and then thirdly, a dividend is a long-term commitment to the shareholder. And so so paying a dividend reflects an understanding of who owns the company. So if I get, you know, good free cash flow, conservatively financed, and an understanding of who owns the company, that's a good starting point to make any investment. Another point I'll make is a lot of times, and Brian alluded to it, but a lot of times companies migrate from one bucket to another. Hopefully the high yielder of today becomes the solid steady of tomorrow, because that would mean the stock went up a whole bunch and the yield came down. Um, Conversely, growers often migrate into solid steady. And so when we look at stocks, with the exception of high yield, where we're where there's a large focus on sustainability of the dividend, we don't really look and say XYZ company, that's going to fit in as a solid steady. It's is XYZ company a good investment today?
No, Tom, I appreciate you adding those points there too, because obviously capital allocation is key for these companies, and just paying a high dividend or paying out majority of earnings may not be actually more strategic or beneficial to the shareholders in the long run. And as you buy these companies, I know both of you across all your strategies, you're buying these companies, you're buying these businesses to hold for a long period of time. So I think all of that makes a ton of sense as you think about how dividends work its way into the strategy, across the different levels of the dividend spectrum. So that was very helpful. And Tom, maybe just to come back to you, how do you see advisors and investors using KDVD within a broader portfolio? Is this something that's more of a core equity income holding, or, maybe a complement to existing dividend strategies?
We think it's a complement not only to existing dividend strategies. If an investor has a large allocation to dividend strategies and likes dividend strategies in general, they probably don't have much invested in smaller companies that pay dividends, so we can be a complement there. I think we also complement, growth investors pretty well because the universe that we tend to look at doesn't have money losing super fast growth companies. And so from a diversification standpoint, that can be helpful. I mean, in 2022, that was really, really helpful. Where our other funds were down, a fraction of what the market was.
What type of clients do you think are best suited for KDVD? When should someone go out there and say, this fund's a fit for me? How would you describe that?
Um, I think I would describe it, why not now, right? Is at the core of what we do, dividend is in the name, right? But we are a Gabelli and Keeley, so Keeley plus Gabelli, as a fundamental bottom-up value manager. Right here, we're just happening by dividend paying stocks because we like the attributes. I think we walk through all the characteristics of why we think dividends are very important. But if there's a small and mid cap allocation to be made, I think looking at a strategy that does invest in dividends provides some attributes that I think is very helpful to a client, especially on a complementary basis, right? If you think of some growth investments or even large cap, the amount of overlap. Tom pointed out the top 200, if you just look at Russell or even the S&P 500, the vast majority of those stocks pay dividends. So are you going to be that much different than what you already own, right? Do you have too much overlap between those types of strategies versus what we do relative to other small and mid cap offerings, right? The fact that we focus on dividends makes us vastly different. In the small cap, only 40% of the stocks, roughly 40% of stocks pay dividend. Mid cap's about 65, so we're sprinkling a little bit, 65%. So we sprinkle in a little bit of large cap as well, but we're already vastly different than the indexes. And then we're also vastly different than the competitive set. Because if you're truly looking for an ETF, a dividend ETF component to your portfolio, 80% of the assets and the bulk of the offerings are tied to mega cap and large cap, as Tom pointed out. So we're kind of trafficking in, as with our history and kind of mantra here at our firm, is overlooked, underinvested, great opportunities. And I think you can get that within these portfolios.
Yeah, I mean, throughout the webinar, you both laid it out so clearly to me. I mean, you could benefit from the tailwinds of attractive valuations for small to mid cap companies, but also the attractiveness for dividend payers, which have been more underwhelming in returns for the last couple of years. So you get the two tailwinds of attractive valuations, and then also through the KDVD ETF wrapper, where we're waiving the fee, the advisory fee on that product for the first year. So just, I mean, adding in the actively managed component as well on the focus of quality and valuation. And not to mention, dividends provide that downside type of protection typically in their nature for the type of companies they are. I think you both laid it out very clearly for why this strategy is so opportunistic for today's environment, but also the product itself is definitely a differentiator, and there's a lot of attractive features to it. Awesome. And I think we're going to move to the more, this is my favorite part of the webinar where we talk about stocks and we really focus on the portfolio. And let's look at maybe some stocks that are in KDVD. Brian, maybe we'll start with you and then we'll move to Tom. Can you share, an example holding of something you really like or that you're excited about within the portfolio?
Yes, definitely. And the stock that I'll highlight here touches on three of the areas. To Tom's point, it's kind of a starting, the dividend's a starting point, but it touches on a handful of areas that we invest in. So I think it makes for a great example. And the stock I'm talking about is Millrose Properties, ticker symbol MRP. It's a 5.1 billion market cap company with a roughly 9.8%, so just shy of a 10% dividend yield. Millrose was spun off from Lennar, the large cap home builder, in February of 2025, so almost a year ago. And Millrose is a one-of-a-kind REIT, and it specializes in land banking services, offering home builders an attractive asset-light option. What does that mean? Home builders' largest asset and source of funds is usually the land that they own that they're going to use to build in the future. So providing that option to contribute that to Millrose ultimately reduces the home builder's risk, right, and improves margins for the home builders as well. And in return, right, Millrose is providing that transparent vehicle to provide land banking assets that will improve these margins, cash flows, and returns. And they'll do it in a just-in-time basis, meaning as they develop the land, they deliver it to the home builder. Home builder pays a monthly option fee for this services, and then they'll take down the land at a pre-negotiated price. So everything's known ahead of time. And then Millrose will reinvest those proceeds into additional land to continue the machine and keep it going. Therefore, creating a self-financed, reliable land availability partner for home builders makes it a very attractive option, especially where we're at in the home building cycle, which could be very attractive. I mean, there's some issues right now due to affordability. The administration is trying to put in initiatives to solve that, as well as home builders as well. But I think the home building space is very attractive. Millrose has increased its dividend in each of the last 3 quarters since its inception. So that's a positive thing. Now, it is a REIT, so it'll pay out 100% or nearly 100% of its taxable income to shareholders. So the yield is high, 10%, but that is the nature of what they do. Two, it was a spinoff, so it's an attractive stock. And three, it has grown its dividend in each of the last 3 quarters. So we like Millrose. It's a fantastic company, and it really highlights some of the things that we do here at Keeley and Gabelli.
Love it. Tom?
All right. So I'll talk, since Brian covered three of the bases, attractive, high yield, and growth, I'm going to give you a solid steady. And the company I'll talk about is called Prosperity Bank, ticker symbol's PB. It's a $7 billion market cap bank headquartered in Texas, pays a 3.3% dividend yield. It is one of the largest banks headquartered in Texas, and is really one of the largest community banks. It's been operating there for decades, and the way it's grown over the years is by acquiring smaller banks. There's lots and lots of small banks in Texas, and Prosperity's been gobbling them up over the last couple decades. Um, what really differentiates Prosperity from our standpoint is it has a very long history of growing its dividend. So the last 25 years, it's grown its dividend each year. Now, if you think about that, that means it was able to grow its dividend in 2008 and 2009 and 2010 and 2011 when when more banks were going bankrupt than growing their dividend. So that tells you something about how that bank is managed. At the present time, has excess capital, an active repurchase program, trades at around 11 times this year's earnings. And so we think there's upside to the stock.
Yeah, and both those stocks really encompass a lot of the themes that we talked about today. I mean, Millrose Properties spinning off from Lennar, Prosperity Bank, a growing dividend payer. I think those two are a great way to conclude some of our larger thoughts from today's webinar. And before we open up the audience to questions, and please, audience, if you have any questions, use the Q&A function within the chat. We'd love to have those questions and have the team go through them. But before we get to the questions, Tom, Brian, anything else that you want to emphasize to the audience when it comes to evaluating dividend strategies?
Yeah, I mean, I would highlight a couple things. One, we covered a lot of ground in a short period of time, so thanks for being a gracious host, Charlie. You were fantastic. But the attractiveness, our excitement about dividends is first and foremost, right? Secondly, the evaluation attractiveness of small and mid caps, right, relative to the large cap, mega cap. And then Tom's example is a perfect example. If I can expand on that, 25 years of raising its dividend. We get asked, or at least it's suggested to us, like, what do you think about dividend kings, right, or dividend aristocrats? If you think of small and mid cap stocks are on those lists, and we really emphasize that when we're at Morningstar in May of 2025. We hosted a trivia session on the power of small caps. And as you would anticipate, it all revolved around dividends, right? And the first question that we asked was, which stock, and there's four options, a couple large cap and a couple small cap, which stock had the longest streak of paying a dividend? And unbeknownst to many of the participants who answered the trivia, it was York Water. It's a small cap utility that has been paying a dividend since 1816, right? That's when James Madison was president of the United States of America. So it just shows you that the power of small caps, the power of dividends, it's just not large cap like you hear in the press or you see on CNBC or the like. It is truly an all-encompassing market dynamic that can be really exploited and invested in small and mid cap given the opportunity set that we have in front of us. So I think just to recap that is truly the opportunity here. And Charlie said the most important part, there's no management fee for the first year. So it makes a lot of sense at this juncture. So Tom, I don't know if there's anything you wanted to add.
No, I think you summed it up great. Thanks.
Great.
And not to
Another
mention
question.
too, the ETF vehicle is just an attractive way to invest in funds going forward with the attractive nature for tax sensitivity and being able to dissipate capital gains. So we're very excited that we're launching not only a strategic portfolio through the ETF wrapper, but getting the benefits of the ETF itself. So a lot of questions coming in, which is great. And maybe just I'll mention ahead of time, since we have so many questions, our team will follow up with the questions we don't get to, because we're definitely not going to get through all the questions that we received, but maybe just doing some of the first ones that came in very quickly as we're coming up on time here. Maybe to start, what role does valuation play when dividends alone look attractive?
So Two answers to that question. First of all, um, in three of the buckets, most of your total return is going to come from price appreciation, not the dividend, right? So valuation and the starting point of the price where you enter a stock is really important to us. We are value guys, and so we expect that the stocks that we buy, we have to have a good thesis of how we're going to actually make money on the stock price, not just the dividend. Secondly, your question is really applicable to the high yield group, right? Where if it's showing up as a really attractive dividend yield, that means it's high. And that means that there may be some skepticism about the abilities to sustain. If I set aside things like BDCs and REITs, where they tend to have high yields because they're paying out all the earnings, right? Most companies that have high yields, there's some skepticism of the ability to sustain the dividend. And so we put extra emphasis there on the balance sheet and their ability um, to ride through the tough time that they may be going through right now. Also, we spend a lot of time there on what we think earnings are going to be out a couple of years because most companies have the ability to get through a bad year and continue to pay their dividends, but there aren't that many companies that can get through 5 bad years and continue to pay their dividends. So that's where valuation actually kind of becomes secondary to what the dividend yield is.
Sure. No, that's a very helpful answer, and hopefully that answered the audience's question. And maybe just really quick answer here. So this one's, I'm an advisor. What are the questions I should be asking when I evaluate different dividend strategies beyond just fees?
Well, we highlighted a few of those already throughout the webinar.
Sure.
Number one is what is it invested in? What type of dividend paying stock or what area of dividend paying stocks is this investment or this ETF looking to invest in? Is it only dividend growth? Is it only high yield? As we showed in the chart, that there's periods of time when dividend growth performs extremely well, and same with high yield. Second is the market capitalization structure of it. Is it all large cap, mega cap versus kind of small and mid cap? And then thirdly, it's kind of the Peter Lynch style of investing is, know what you own. Really look at what this ETF is invested in, how it's invested, right? Are they taking large overweights in certain stocks? Are they just trying to play themes within the dividend space? I mean, NVIDIA, Microsoft, and all those pay dividends, right? They do have a dividend. It's a very minuscule dividend, right? Are they just trying to exploit that and try to play the AI and tech thing without being a truly durable and sustainable process, right? We're really looking for quality, timeless valuation. We're looking for certain stocks that fit within that category. So really just understanding what type of A, dividend stocks they're investing in, and B, what their process and philosophy is, and how it complements the rest of your portfolio.
And let me add too, just despite being a newer strategy, this is something you guys have done successfully for 16 plus years, and you're almost taking the best of the two funds that your team has managed for a long period of time and bring it to this ETF wrapper, which is just the best of both worlds for clients looking to invest within the small to mid cap dividend space. So that's fantastic. And questions are still coming in, but unfortunately we are running up on time here, but continue to ask questions and a member of our Gabelli team will be happy to reach out and answer those questions. And Tom and Brian are always so kind with their time and providing answers to the questions and always happy to answer additional questions from the audience. So thank you both, Tom and Brian. Maybe to wrap things up here, so KDVD represents an opportunity to access a time-tested dividend investing approach in a modern, tax-efficient ETF structure. As an added benefit, the advisory fee will be waived for the first year from the fund's launch date of December 8th, 2025, before transitioning to a 90 basis point fee. I know we talked about that a few times today, but it's actually a very attractive point that differentiates this fund from a lot of other launches. With Tom and Brian's 16 plus years of experience managing dividend strategies together, KDVD brings together continuity, discipline, and deep fundamental research to investors seeking capital appreciation and current income through investments in dividend-paying stocks. For advisors, KDVD can serve as a differentiated equity income allocation with a focus on small and mid-capitalization companies designed to complement existing income strategies, which we've talked about in depth today. We believe the strategy is well-positioned across a range of market environments with the potential to benefit from both attractive valuations in smaller companies and durable dividend payers. We encourage you to reach out to your Gabelli representative for additional materials and portfolio positioning ideas, and to discuss how KDVD may be a fit within client portfolios. To learn more about KDVD or any of our other ETF strategies, please email us at etfs@gabelli.com or visit us online at our website at www.gabelli.com. Thank you again for joining us today. Thank you, Tom and Brian, for your time, and we look forward to continuing the conversation.
Thanks, Charlie.
Thank you, Charlie. Thank you, everyone.
Thanks.
Tom Brown and Brian Leonard are portfolio managers for the Keeley Dividend ETF. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. Shares of this ETF are bought and sold at market price, not NAV, and are not individually redeemed from the fund. Buying or selling ETF shares may require additional fees such as brokerage commissions, which will reduce returns. These additional risks may be even greater in bad or uncertain market conditions. Dividend-paying stocks do not assure a profit or guarantee against a loss. Companies may choose to stop paying dividends at their own discretion. You should consider the ETF's investment objectives, risks, charges and expenses carefully before you invest. The ETF's prospectus is available from G. Distributors, LLC, a registered broker-dealer and FINRA member firm, and contains this and other information about the ETFs, and should be read carefully before investing. To obtain a prospectus, please call 888-GABELLI or visit https://www.gabelli.com/funds/etfs/intro. Distributed by G. Distributors, LLC, a registered broker-dealer and FINRA member firm. 1 Corporate Center, Rye, New York, 10580.